Hello everyone. Welcome to the webinar hosted jointly by NDB Securities, a subsidiary of NDB Capital Holdings, NDB Wealth Management, together with Tellimer Insight. Today we are going to discuss what lies ahead for Sri Lanka in terms of domestic and external debt restructuring and beyond. So let me introduce the panel. We are pleased to have Professor Lee Buchheit and Dr. Indrajit Coomaraswamy with us today. Professor Buchheit is one of the leading experts in sovereign debt restructuring. He has over 40 years of experience in legal practice, and he is involved in more than 24 of sovereign debt restructuring. His academic career spans over several universities and is currently served as the honorary professor at the University of Edinburgh in Edinburgh Law School. And next we have Dr. Coomaraswamy. He was the 14th governor of the Central Bank of Sri Lanka. He has held a number of senior positions at the Commonwealth Secretariat and has also served as a member of the Monetary Policy Consultative Committee of the Central Bank and an advisor to the Ministry of Development Strategies and International Trade. And let me introduce the two moderators. We have Vindhya Jayasekera, CFA, Chief Investment Officer at NDB Wealth Management, and Patrick Curran, CFA, Senior Economist at Tellimer, moderating the session today. So before we begin the discussion, I will take 2 minutes to give a brief overview of the events that happened in Sri Lanka over the last 1.5 years. Now, this is especially for the benefit of our foreign audience. Let me quickly share my screen. Okay, there we go. So last year, it was a challenging year for Sri Lanka. The public finances were deteriorating due to the tax cuts in 2019. External accounts were weakening with a growing balance of payment deficit. And by April 2022, the country's usable reserves fell to as low as $50 million, and this led the government opting for a preemptive external debt default. Sourcing of essential imports obviously became a problem due to the extremely thin forex liquidity, and this led to queues for fuel and gas, and ultimately the economic crisis escalated into a full-blown social crisis. This resulted in the ousting of the then president by the citizens. In the aftermath of all these events, we saw exchange rates falling sharply, inflation was raging, and by September 2022, the headline inflation, it has increased to 70%. And domestic interest rates, they exceeded even 30%. And then in September 2022, Sri Lanka successfully reached a staff-level agreement with the IMF, and the board-level approval was given in March 2023 for $3 billion extended fund facility. And by June 2023, inflation started to moderate sharply. This was largely due to the base year effect, and the central bank did a policy pivot, easing the interest rates for the first time since August 2021. In July, the long-awaited domestic debt restructuring proposal was announced with the treasury bonds held by the superannuation funds, SLDBs, foreign currency loans by the FCB units, and the treasury bills held by the Central Bank of Sri Lanka being slated for restructuring. Now, fast forward to this August, the SLDB restructuring was successfully completed with a 97% participation. Second. Sorry, I missed this slide. So you have the overview here. So there you go. I was explaining the chain of events, and now we are in August, and the SLDB restructuring was successfully completed in this month with a 97% participation. However, the T-bond restructuring is on a second extension right now, And 30th September has been announced as the long stop date. So far this year, central bank has reduced interest rates by 450 basis points, and the SRR has also been reduced by 2%. So with that, I would like to hand over the session to Vindhya and Patrick. Over to you.
Thank you, Ajapani. Hello, everyone. Dr. Coomaraswamy, I'll start the session off with you. I'll kick it off. So I think everybody is very interested. There have been multiple delays in implementing the DDO. The newest extension has been announced last week, and there's a long stop date also incorporated into it. Also, central bank balance sheet restructuring is pending. Can you explain the repercussions of the long stop date? And do you think we can complete this DDO as planned? Or do you think after 30th September, it's back to the drawing board?
Okay, thank you very much, Vindhya. And let me greet everybody, I don't know, in different parts of the world, I guess. So a good evening and good afternoon, wherever you are. And good morning, of course, to Lee, who's in the US, and Patrick as well. It's a pleasure to be with you. On the DDO, let me first give a very short answer and then try and elaborate a little bit. First thing to say is that the long date has got nothing to do with the DDO. I'll try and explain why the long date has come about. So there is the question of having to start from scratch again after the 30th of September. That's just not on the radar at all. And secondly, on the central bank balance sheet, that will look after itself, and I'll explain to you how it will. So that, you know, things are pretty much on schedule. Why has the completion of the exchange on the DDO been delayed? And that is because when the monetary board approved, because you know the monetary board is the custodian of the EPF funds. So the treatment of the EPF bonds needed to be approved by the monetary board. And when the monetary board gave its approval, it also said that it wanted the Inland Revenue Bill, which was going through Parliament at the time, for that Inland Revenue Bill to be enacted before the actual exchange took place. So that bill got delayed. It is now expected, I think there's a court decision expected today, because I think that bill was challenged in some way, and that has led to some delay. And I think the court decision is expected today, I was told. And so the Parliament will approve, there's no reason why it should approve the Inland Revenue Act in the first week of September, in the sessions it has in the first week of September, which is why you have the 11th September execution date for the exchange. So the delay has got nothing to do with the DDO or any problem with the DDO. It has got all to do with the decision the Monetary Board took to first get the Inland Revenue Act, the latest amendment to the Inland Revenue Act, through Parliament and enacted before this went through. So that's the delay. So there shouldn't be any problem. On the central bank balance sheet and the conversion of the bills into central bank TB holdings into bonds, the central bank, the negative net worth on the balance sheet last year was negative, even before the DDO. But due to A, marking to market, and B, the profits the central bank has made, particularly on the exchange rate, I think it has made profits of something like ₹500 billion, I saw in the press a couple of days ago. The balance sheet is looking pretty healthy now. And even after the DDO, the balance sheet will be positive. So it won't go into negative territory. But it may take a year or two to build the reserves up to prudential levels. So there is no big challenge in terms of treating the central bank balance sheet as a consequence of the DDO. So the two issues that you raised, I think will look after themselves. One by about the 5th of September, whenever the Parliament is meeting for the Inland Revenue Bill debate. And then the central bank balance sheet is kind of looking after itself in terms of what is transpiring on the ground. Thank you.
Thank you, Dr. Coomaraswamy. Just to elaborate on that, is there a date in terms of the central bank balance sheet restructuring, like a proposed timeline? Are we waiting for the DDO to be concluded on this side?
I mean, it is kind of balancing itself out. As I said, profits are pretty high, all right? So they're already very substantial, and they can absorb the DDO without the central bank's balance sheet net, the net worth going into negative. So only thing is there are some prudential norms the central bank has for reserves, and to build those reserves back up after the DDO. Now they're comfortably above the reserve prudential reserve level, but after the DDO it'll slip down below that. But within a year or two, they expect to be able to build up the reserves to the prudential norms. So there is no kind of deadline as such. I think through the operations of the central bank and the profits it will earn, it will right itself.
Patrick, you want to take the next one?
Sure. Thank you, Vindhya, and thank you, Dr. Coomaraswamy. And I just want to say up front, since we didn't mention it, but this call is off the record, just to promote as open a dialogue as we can, both in the formal part and in the Q&A later. But Lee, this question is for you. Is there a risk that Sri Lanka's restructuring fails to restore debt sustainability, given that public debt only falls to still quite elevated 95% of GDP by 2032 and remains above 100% of GDP through 2029, even if Sri Lanka delivers on its reform promises? And is there a risk that there is a follow-up restructuring in the future if Sri Lanka fails to deliver under its IMF program?
Thank you, Patrick, and I'll add my greetings to everyone joining the call. I'm afraid there's always such a risk. It is in part a result of the fact that none of us know what the future holds. You can run your spreadsheets to say that if everything remains in a normal state, the country will return to debt sustainability, but something can also go wrong. The projected 95% of GDP target itself is not fatal to the prospects here. There are many countries that run debt to GDP levels well above that level. It is a question of the terms of that debt, its maturity, and of course, its interest rate. So I don't think there's any reason to believe that this debt restructuring will from the outset be inadequate, but I don't think anyone can promise that it will definitely restore debt sustainability to the country. Things always can go wrong.
Thank you, Professor Lee. Dr. Coomaraswamy, if I can pose another question to you. If you look at the IMF program, the implementation has always been a weakness on our side. So this time we've implemented a lot of prior action, but there's a lot more required, including structural reforms, institutional reforms. And, with the crisis, we had a lot of political will to do this, but as we move out of the crisis, I think that political will is diminishing, especially in the upcoming election cycle, and there are also weather-related risks. So given all of this, what do you think, what is the likelihood that Sri Lanka will be able to deliver on its IMF reform targets, especially including the proposal for the sustained primary surplus of 2.3%? Because in the past, we've found it very difficult to have sustained primary surplus on our part.
Okay, thank you, Vindhya. I hope you'll permit me to answer that question in two parts. First, to make some comments on what I think the prospects are for the first review of the program, and then to talk more broadly about the program as a whole. On the first review, I think we seem to be in pretty good shape. There was an IMF team that was in Colombo about 3, maybe 4 weeks ago, and they went away reasonably satisfied. And in a number of aspects of the program, Sri Lanka has outperformed, has overachieved. On the monetary side, the quantitative targets have been met. And I saw the CPI print just came out, and for August, it's 4%. So that's really at the bottom end of the band, of the range. And when you think it was 70% in September of last year, and of course the governor and the monetary board took very decisive action, and of course ill-informed people criticized them for it, but now I think they're being fully justified, because in a year's time they brought inflation down from 70% to 4%, which is much faster than expected, and certainly by the end of the year it's going to be within the range. So on the monetary side, we've overperformed. On the external side, as you know, our usable reserves were down to almost 25 million on the day we declared the standstill on the 12th of April, 2022. Now the usable reserves, I mean, gross reserves at the moment are about 3.8 billion. If you take away the PBOC swap, it comes up at about 2.3, 2.4 billion. From 25 million, in about 18 months. So on the external side too, we've seen this very good performance. The quantitative targets have been met. Where there is some slippage is on the fiscal side. On the revenue side, the target has not been quite met. The government has taken some remedial measures. Some duties have been adjusted, and the tax administration, they are having a concerted effort to strengthen tax administration, including greater use of RAMIS, the Revenue Administration Management Information System. And they're trying to set up a revenue authority whereby they combine the Inland Revenue, the Customs, and the Excise Department to have a more streamlined revenue operation. So there are, we are a little bit behind on the fiscal side. Remedial action has been taken. And what's encouraging is that in the first 6 months, there was a very small, but there was a primary surplus. As you said, this is not something we have achieved very much. Since 1954, there have only been, I think, 3 years when we've had a primary surplus in the budget. But we have managed to achieve it in the first 6 months of the year, and we need to persist. So in terms of the first review, I don't see any problems about getting through it. And of course, the progress has to be made on the debt restructuring as well. I'm told it doesn't have to be completed as such, as long as Sri Lanka demonstrates it has been cooperating. And I don't think anybody can challenge the fact that Sri Lanka has cooperated and progress is being made. So hopefully that should also not delay the review. But later on, when we talk about the debt restructuring, I think that too can be completed by October, November. Okay, so that's the review. In the longer term, and you said there were issues that could disrupt the program, like weather and the election. So let me talk about each of them. Yeah, let me talk about each of them. We have had, 16 programs before this. The majority of them were suspended because we couldn't implement the program in full. As for the weather-related disruption, at one time it seemed the drought might affect agriculture, but the latest reports I've seen from afar, from 3,000 odd miles away, is that the rains are going to be such that it shouldn't be disruptive, that the rains will come in time for the Maha cultivation for the main season, and we already have stocks to see us through till March, April, the next harvest. And if the next harvest also works out quite well, the food security side of it, hopefully, unless the rains that are now predicted lead to floods and there's a natural disaster, this should be okay. And on the power side too, the Ministry of Power and Energy has been saying, and the CEB have been saying, that there shouldn't be any disruptions in terms of power generation and power service. But there could, of course, be a change in the mix of generation. And if we have less hydro, it could become more costly. But the one good thing is that it will no longer move on to the budget, right? Because with the pricing formula that's now in place, that will be absorbed in the price of electricity. Now, what is more tricky, and also I should say, if there are weather-related disruptions to the meeting of targets in the program, you can negotiate waivers. If the miss is due to factors beyond the control of the authorities, you can't negotiate a waiver, or else you can re-engineer, redesign the program in such a way at a review, because there are biannual reviews, to take account of the disruption that has taken place due to weather or a natural disaster. Now, the electoral cycle is much more tricky, and that does, I must say, worry me. I must tell you, I'll be very frank, that historically we've had 16 programs. More times than not, the dissipation of political will, once the crisis period passes, is when things begin to go awry. Now, this time we've had a bigger crisis than we've ever had, and I'm hoping that that the politicians have learned a lesson that you can't deviate. I hope the officials realize that they have to do their job and resist when politicians do the wrong things. And the public needs to speak up when they see obviously wrong things. If there are totally injudicious tax cuts, or now the law is there not to print money. If money starts getting printed, I think the public should not keep quiet. For too long, the public has kept quiet, officials have kept quiet, and the politicians have run amok. So we cannot allow that to happen again. I'm hopeful that the politicians have learned enough from what the country was a year ago or 18 months ago, not to repeat the same mistakes. If they do, the situation will be much more severe than last year. It will be nothing like we've ever had before, even what we had last year. This is the message I'd really like to deliver. 7, 8 years ago, I was telling people that we could end up like Greece unless we changed our behavior. We didn't, and everybody knows where we ended up. Let me say now, if we don't learn the lessons this time, it's going to be worse than it's ever been, worse than it was last year. Okay.
Thank you, Dr. Coomaraswamy. I think there are a few points that I want to circle back to, but I'll leave that be for a minute, and I'll come to Professor Buchheit. Actually, Professor, so the presentations held for the DDO appear to indicate that the government will propose a 30% haircut for the ISB credit holders. What is your opinion on the likelihood that the external creditors agreeing with this figure? And in the event that bondholders advocate for a haircut of less than 30%, do you think we can still achieve our DSA targets?
The 30% principal haircut was signaled for the bondholders, not for bilateral creditors. They are expected to stretch out at par. Bondholders are prepared to entertain a request for a principal haircut. One has to look, however, at the other terms that have been signaled for the bond debt restructuring, and they are, in the context of sovereign debt workouts of the last 20 years, fairly generous. It is a 6-year stretch out only, no grace period, amortizations in a straight line, and a 4% fixed coupon. Now, I have to believe that the government has a basis to be reasonably confident that terms like those will be acceptable to the bondholders. To have announced them without at least a wink and nod strikes me as tactically hazardous. So I have to assume that those terms are at least broadly going to be acceptable. There will be areas to be negotiated. The two obvious ones are, first, the treatment of the past due interest known by its acronym PDI. The government has indicated it wishes to pay the past due interest, perhaps as much as 10 points, in local currency. That I would expect will be problematic for the external bondholders. And the other area will be what are called value recovery instruments. These are instruments that are issued by the debtor country at the time of the restructuring and which will begin to pay off if it turns out that the assumptions used for projecting debt sustainability turn out to have been too conservative. The history is that in the Brady period, the early 1990s, where large oil exporters, Mexico, Nigeria, Venezuela, did their debt restructurings, they issued oil warrants that would pay off if the price of oil exceeded what had been projected in the debt sustainability analysis. In more recent years, you've seen this technique used and based upon the GDP of the debtor country. If the GDP exceeds the projections, then the argument that the creditors make is that shows that the country can afford to recompense the creditors for some of the debt relief they provided. Now, the creditors will argue that they are, at least in part, the authors of that future prosperity. So those are areas that I would expect would be negotiated, and there may be some negotiation around the terms. The government must view that negotiation as a whole. The creditors can come back and say the principal haircut is too great. Then the response is, well, then maybe the interest rate goes down or the maturity gets extended, that sort of thing. It's a dynamic.
Thank you, Professor Buchheit. That was very. I think we had a couple of questions in the lines of the maturity extensions as well. I think that was a very comprehensive answer. I think also in terms of post-debt restructuring, if I can come back to you, what has been the international experience on the time taken for a rating upgrade and regaining market access? So, for example, IMF's assumption for market access is 2027. Is 2027 realistic? And even given our reserve levels, is it desirable?
Let me take that in two parts. First, on the ratings upgrades. The history has been that if a country completes a sovereign debt restructuring, and it is perceived by the market and the credit rating agencies as being durable, by which I mean that it is likely to return the country to debt sustainability, the rating agencies typically take the country off of the selective default credit rating reasonably quickly. It can be a matter of weeks or months for them to lift the country out of the selective default category. That doesn't mean they'll put them back to investment grade in that period of time. As I said at the outset, there are a lot of uncertainties in these things, and whether the country has returned to durable debt sustainability issues, such as Dr. Coomaraswamy mentioned a moment ago, the impending election puts a cloud over it. As to when the country can return to the markets, that's more complicated and difficult to predict. Some might argue that the country should not wish to rush to return to the markets. because that will continue a practice of relying upon external borrowing to cover budget deficits. But it will be in part the condition of Sri Lanka and how successful this debt restructuring it is, but it will be in equal part a question of how munificent the markets feel. If we were to return to a period that we have come through recently, in which the large central banks of the world have been literally stuffing liquidity into the maws of the world's financial institutions, and they had to redeploy it, yes, the market may well want to begin lending sooner rather than later. But we are not at that point in the cycle. If anything, we're in the quantitative tightening period of the cycle. And so there isn't as much liquidity sloshing around in the market. What will it look like in 2027? I'm afraid I don't know, and I doubt anyone does.
Thank you. Patrick, you wanted to ask a question, sorry.
Sure. Thank you, Professor Buchheit. You anticipated a couple of my questions, including on value recovery instruments. So I think I'll skip ahead maybe. Sri Lanka is the first country to restructure under the IMF's new DSA framework for market access countries. To what extent can Sri Lanka's restructuring be seen as setting precedents for future restructurings under this framework? Relative to the low-income country DSA, the MAC DSA appears to be much more opaque, with more room for judgment. Are there any implications of this for future restructurings, or any refinements as you see it that could potentially be made moving forward?
The debt sustainability analysis that the IMF and sometimes the IMF and the World Bank go through has been the subject of considerable attention over the last few years. The criticism is that a debt sustainability analysis is a compilation of predictions about the conditions in the future. Those predictions for the first couple of years after the debt restructuring are informed guesses. Years 3 to 5 or 6 are speculation. After that, it's an exercise in occult divination. No one knows what the world will look like in the 2030s, and the criticism of DSAs is that because it is a compilation of guesses, whether you are conservative, whether you are a pessimist or an optimist in preparing the DSA, will considerably change the dynamics of the debt restructuring. And it is for this reason that private sector creditors have begun to rely pretty heavily on these value recovery instruments. Their argument is, if the author of the DSA turns out to have been too conservative in their guesses about future events, then the value recovery instrument can at least in part recompense the creditors for that conservatism. Will it set a precedent? Yes. These sovereign debt restructurings over the last 40 years have always been incremental and cumulative. So what is done in one is watched very carefully, and if it appears to have succeeded, will influence future debt restructurings.
Thank you for that answer. I think as you've alluded to, forecasting obviously is a lot more art than science. I think occult divination probably is an appropriate way to describe it. We've seen varying takes on the assumptions in the DSA, including on the fiscal targets, which many, including ourselves at Tellimer, see as potentially overly optimistic. On the other end of the spectrum, there's growth assumptions around 3% over the medium term, which look quite bearish compared to a historical norm close to 5%, and also an exchange rate assumption of around 400 to the dollar on average for the year, which compares to current exchange rate of around 320 to the dollar. So Dr. Coomaraswamy, can you provide some thoughts on where exchange rates could be headed through the rest of the year? And how much of this year's currency strength, in your view, can be attributed to things like import and FX restrictions, and it can therefore be seen as temporary and likely to lead to weakness as the year progresses?
Okay, I think I left an important piece out in my first answer. I should have also said, in terms of our performance so far, on the structural issues as well, there have been some important advances. The CBSL Act, the Anti-Corruption Act, the Banking Special Provisions Act, all these are very important things that have already been achieved. So I think, as I said, the story so far is impressive, and we need to sustain our performance and not let it get distracted by matters which are within our control. There may be, as Lee said, one thing is for sure: the world is in an extremely uncertain place, and things can knock us off our balance. But things which are within our control, we shouldn't have self-inflicted harm, as we have had in the past. Okay, on to respond to your question, I think the strength, or at least the strengthening of the exchange rate, but it was down at 360 and then went up to about 280, I think, and it's now at about 320.26 this morning, I think, to the dollar. I think a combination of things. Certainly the import and FX restrictions were part of the story, because imports actually came down significantly from close to about $2 billion a month. At the trough, it was down to about just over $1 billion. It's now about, I think, 1.3, 1.4 billion per month. So those restrictions did have a role to play. But now most of those have been taken off. Most of them have been taken off. There's still some vehicle import restrictions, though commercial vehicles have been liberalized. But that's one part of the story. The other thing, of course, is the extremely tight monetary and fiscal policy. That is, of course, compressed domestic absorption, investment and consumption have been compressed, and that has had an impact on the demand for dollars in the system, and that has helped to strengthen the exchange rate. So what's going to happen but of course that has all been achieved but at a low equilibrium, in the sense that the economy has contracted by close to 8% last year, 11% the first quarter of this year. And I think the central bank was projecting a 3% contraction for this year. I think they're probably going to change that. But anyway, so really the stability that we have achieved in terms of the exchange rate and more broadly in terms of the economy has been on the back of this economic contraction. Clearly, that has to be turned around. We have to achieve 3, 4, even 5% growth and still have stable macroeconomic fundamentals. So that is the challenge we have to have going forward. Okay, more specifically on what I think about the exchange rate, given my previous incarnation, I don't want to speculate about a particular rate or a range, but let me talk a little bit about the policy framework and what I think is going to influence that in the short run. So as far as the framework is concerned, we have a flexible inflation targeting regime. Within a flexible inflation targeting regime, it's only the inflation rate that's targeted. Historically, we have tried to target the exchange rate and have done so by depleting our reserves, much to our detriment. Now we only target the inflation rate, and the exchange rate is allowed to fluctuate. according to the underlying market dynamics. Of course, the central bank will intervene if there is sharp volatility to smoothen out the volatility. So what's going to happen, in my view, going forward, if you look at what's going to happen both on the demand side or on the supply side of the FX market, that might give us some indications of how things might play out. So on the demand side, we've the relaxation of import and some capital controls clearly is going to increase the demand for FX. And as the economy picks up momentum, and I think we're on the cusp of the economy getting into positive growth territory now, and hopefully it will pick up going forward, that will suck in more import. So the import bill will go up. And if there are weather and other related factors which lead to increases in imports of foodstuff or oil, that would have an impact, obviously, on the demand for foreign exchange. One other thing in the next couple of months we need to look at is what's happening in the Gsec market. From about February of this year, there was portfolio capital that has come into the government securities market. Roughly, I think about 600 million in all has come in. Now, as government security yields come down, and of course the data yesterday wasn't so good in the US, the Fed may or may not tighten more, but the differential has come down significantly. And these people have, I think, gone into treasury bills, 6 and 12 months treasury bills from February onwards. When these mature, we would need to see what they do. With the compression of the differential between the risk-free US treasury rates and our yields, I don't know whether they will move from bills to bonds, because still it's pretty attractive. The bond rates are around 14, 15%. Or will they take the money out of the country? So there is that 500-600 million, which may or may not move out of the country in the coming months, and that will be something to keep an eye on. So that's what's likely to happen on the demand side of the market. On the supply side, there are a number of positive features. So tourism has picked up, as you all know, and I think, if I'm not mistaken, if I look up this figure, the tourism earnings increased by 43% to USD 1.1 billion in the January to July period, and we may end up by close having proceeds of roughly around 2 billion by the end of the year, which would be a significant increase. Remittances increased by 78% to US dollars 3.4 billion in the Jan to July period this year. Hopefully, we will start approaching the historical figure of somewhere between 6.5 and 7 billion. So that's, again, additional inflows that can be expected. Then the proceeds from diversification. The government has identified 7 entities for diversification. That hasn't moved as quickly as one would have liked, but my understanding is that it is moving. And hopefully some of the transactions will get done. The transaction advisors have been appointed for these 7 entities. And if some of that is transacted through, and some proceeds will accrue from those transactions as well. And hopefully the conditions are improving for other FDI. There is some kind of FDI on the India-Sri Lanka relationship, which is now being built up on the back of the president's visit to Delhi recently. So there could be some FDI coming in on those projects, particularly those connectivity projects that are being talked about. And of course, there is the West Terminal in the port and some of the renewable energy projects which have been signed with the Adani Group. So that money should also start coming in. And the valuations on the Colombo Stock Exchange are extremely attractive, particularly for the strong blue chip companies. So some money has come in, and if we get the first review out of the way and the debt restructuring out of the way by sort of October, November, we could well see significant inflows of money into the Colombo Stock Exchange. And the other source, which I think one should keep an eye on, is Japan. The Japanese, I think, are waiting for the debt restructuring to be completed because they don't feel it's appropriate to lend more money to a country which has been defaulted. But once we get through the debt restructuring, I think, and the IMF review also is behind us. They will, I think, restart the airport project, and they will take on, I'm told, the light railway transit system. And Japan in the past has given budgetary support on the back of usually the World Bank kind of development policy lending. And talking about that, I think the multilaterals have been providing, will continue to provide support. Already, I think there is money already in the pipeline for this year from ADB, the World Bank, the IMF, if we get the review done. And of course, and Japan, if we get the debt restructuring done. And so there could be about $1 billion or more dollars of monies that come in. So, there's quite a lot that can happen on the supply side. In fact, it's encouraging that the governor, who is not prone to exaggeration, I mean, we worked together for 3.5 years. He's not a man who kind of is prone to exaggeration. And he has been talking about getting our reserves back up to 10 billion over time. So we're at 3.8 billion, including the PBOC swap. So there's quite a lot of supply that is in the pipeline. Of course, demand will go up as well. So unless there are some very untoward shocks, I don't see big volatility in the exchange rate market. On the interest rate, so we've already seen a significant reduction as I think Vajrapani in her introduction talked about the reduction that has taken place in the policy rates already, and the SRR, and we see, and I see rather, probably scope for a little bit more, though just in the last week or so, the yields in the treasuries market did tick up a little bit. I suspect it's because there has been a lot of misinformation about the DDO, which may be disturbing the market. But I think once people realize what's happening, hopefully the downward trend will continue, and there is scope for rates to go down a little bit more, in my view. So that's basically my story on rates. Have I covered everything that you wanted me to speak about?
Yeah, that was perfect. Thank you for that, Dr. Coomaraswamy. Vindhya, I'll hand over to you for your question.
We have a lot of questions coming in from the audience as well. So, but I want to switch gears a little bit before we move on to audience questions. Dr. Coomaraswamy, I think we need to talk about taxes. So, that according to the IMF requirements, it's likely that we will see proposals for property taxes, transfer taxes being introduced in the upcoming budgets. Sri Lanka is already tax fatigued with recent increases in indirect taxes, on top of high inflation. Real wages are yet to catch up. So, in your opinion, is there space to drive economic growth with all these elevated taxes contributing to depressed consumption? Also, don't you think there is a more compelling argument to broaden the tax net? And tax one base? More thing, tax base, yes. Yes, sorry, tax base.
Okay, thank you. Let me say this first. Yes, the burden of, as Sri Lankans, and I include myself in this, we want to have Scandinavian type welfare state and a Hong Kong rate of taxation, right, which is 10%. Now, sadly, that just doesn't add up. And when we don't get that, we get disturbed. So we, I think, need to understand we have expenditure which is running roughly about 19-20% of GDP. Now, you can question the quality of a lot of that expenditure. I think there has to be some expenditure switching. We are spending far too little on health and education. And we need to find ways of switching expenditure into those areas. But but 20% of GDP for a country like us for expenditure is not a bad figure, right? But as I said, we can improve quality. Revenue came down to 8.2%. I mean, that's a ludicrous figure. right up to about 1996, we were collecting, I was seconded from the central bank to work in the treasury in the 1980s. The country regularly collected over 20% of GDP as revenue. But it is true that much of that revenue came from taxing the tree crop sector. Tea, rubber, and coconut that historically made surpluses, which we taxed. We built our free education and free health system by taxing that sector. We also exploited the workers to increase that surplus, and we built that thing on the back of those workers. But still, anyway, whatever it is, those surpluses have disappeared. And so we can't get tax from there. And we have not replaced those sectors with new dynamic sectors. The new dynamic sectors have had tax holidays. That's the real problem. We've had all these tax holidays. So we've had this structural problem with the budget, which we need to address. Right. So we need to go from what, 8.2% last year, I would say at least to 15, 16% over time. I'm not saying it can be done immediately, over time. Because we can't have a budget deficit of more than 3 or 4%. So 19, 20% expenditure, 15, 16% revenue. Now, in order to get there, one thing is that we have to remove tax exemptions. We can phase them out in some sectors, but over time, particularly if we improve the investment climate, if we reduce the transaction cost of doing business, because that is what we're doing. Because we don't do any of those reforms, we have to give away taxes to compensate for the lack of action on areas where we should have action, or to have a proper long-term power generation strategy. So if we do all those things, and if on those 10 pillars of the World Bank's Doing Business Index, which it's no longer being published, there were some issues there, but anyway, those pillars are very useful. And we don't do well. We were 101st, I think, the last time the index came out. So if we improve the environment for doing business in the country, then the need for tax concessions becomes less. We can collect more tax. And I think then maybe some of the taxes that are now being imposed can be eased if we're collecting more tax as a result of the removal of the concessions. But from where we are, Vindhya, we have no choice, right, but to have new taxes to be able to get up to that 15, 16%. As you said, we can't tax the indirect taxes on the poor and the rest of the population, we can't go more than where we are now. And the direct taxes on the middle income groups, I don't think we can do more than we are doing now. So we have to look for new taxes which are directed towards wealth. And, the basic principle of taxation is the capacity to pay. Now, in terms of the adjustment, the IMF targets that we have been given, the 3 targets, debt to GDP 95%, the external debt service and GDP 4.5, those 2 are achievable in my view. The most challenging one is the gross financing needs of the government, which has to come down from over 30%, 32, 33% in 2022, down to an average of 13% in 2027 to 32. There, for that to happen, we have to increase revenue and, reduce the borrowing requirement in the budget. And also, if we don't do that, we're going to have very high interest, particularly as the central bank can't print money, we're going to have extremely high interest rates. And the economy is not, it's not just high taxation that's going to discourage economic activity, but the fact that very high cost of credit, which is probably a bigger factor in terms of discouraging economic activity, would be inevitable if we have to raise more and more money from the market, simply because we're not raising enough revenue. So, really, in terms of getting revenue up to 15, 16%, which we have to do, I don't think one can do it in terms of the usual sources of revenue. We have to improve tax administration, because tax administration is extremely poor, and we have to think of new taxes. And those taxes should fall on those who can afford to pay.
Thank you.
Thank you. So I'll do one last question for Lee and then move on to the audience Q&A. I do see there's a number of questions already in the Q&A box. Certainly, if anyone has any others, feel free to add them to the list or to raise your hand. I do see we have a hand raised, which we will get to and call on. But before I open it up to the audience, Sri Lanka has been sued by one bondholder, Hamilton Reserve Bank, in a U.S. federal court in New York. Is the government at risk of being sued by other bondholders before a debt restructuring can be completed?
Patrick, I think in the near term, no. Sri Lanka has issued its ISBs, its international bonds, pursuant to U.S. trust indentures. This is an interesting legal construct. In a U.S. trust indenture, until the security matures according to its original terms, it is the trustee who enforces the instrument in a legal proceeding. And of course, the trustee would do so and distribute any recovery ratably among all bondholders. So a sovereign bond issued pursuant to a trust structure does not attract the more litigious holdout creditors because they cannot bring the lawsuit on their own. The only ISB that has matured already was in July 2022, and that is the bond that Hamilton Reserve Bank bought, and that is why they were able to bring a lawsuit in their own name and not have to go through the trustee. The next ISBs to mature, I believe, will be in next spring. So that it is only when we get to that point, if a debt restructuring has not been completed, that the government would have to worry that individual holders of that bond might be able to begin bringing lawsuits on their own. So the trust indenture structure by which Sri Lanka has borrowed in the past, it acts as a pretty effective brake on litigious creditor behavior.
Understood. Thank you, Lee. Again, we'll open up the Q&A now. I'm going to do my best to combine similar questions to keep this as efficient as possible. And again, feel free to put your questions in the Q&A box or to raise your hand if you have any others. To kick things off, for Lee, can you provide color as to how the bilateral lender negotiations have been going? Is China likely to go with the recommendations of extensions while the external debt holders get the terms that we've outlaid? Relatedly, what's holding back official creditors from providing a swift treatment for Sri Lanka, and what lessons can be learned from other recent cases to help Sri Lanka speed things up? And if I can take the liberty and combine a few other questions at the end of that, there's a few different comments on the most favored creditor clause, including what significance does this hold for the SLDB treatments? What are some potential legal hurdles to use of the most favored creditor clause, and what are the prospects for this being a part of the broader restructuring for Sri Lanka?
Okay, there's a lot there. The current environment is that bilateral creditors are no longer the traditional Paris Club, the OECD country lenders. In the last 10 years, China has been the largest bilateral lender, and we now have countries like India and Saudi Arabia that are joining that non-Paris Club bilateral club. The concern has been that there is no forum in which bilateral creditors can jointly renegotiate their claims against an emerging market country. That forum had been the Paris Club since 1956, but with the addition of significant, very significant non-Paris Club bilateral creditors, there is no central forum. In 2020, the G20 countries tried to solve that problem, at least for the 73 poorest countries of the world. Sri Lanka is not on that list, by promulgating something called the Common Framework, in which theoretically all bilateral creditors would be sitting at the same table, agree jointly to terms, and implement those terms. But Sri Lanka is not in that group, and even the countries that are in that group have not seen the Common Framework lead to speedy and orderly bilateral sovereign debt restructurings. So there is and will be a degree of suspicion between traditional Paris Club creditors, non-Paris Club creditors, and commercial creditors. They each will worry that they are being asked to provide debt relief that is disproportionate to what one or more of the others is doing. And this has bogged down the process in the last couple of years, particularly for countries like Sri Lanka and Zambia, and to a degree Ghana. I don't think that it is going to be that difficult for the government to negotiate with the Paris Club. The question will be, will China join that? Or will China say we wish to do an independent exercise at some point in the future? And that is where the question of a most favored creditor undertaking enters the picture. The way the Paris Club, for example, could protect itself against the possibility that China extracts preferential terms in the future would be to obtain some form of undertaking from the government that it will not accord preferential terms to another bilateral creditor, or for that matter, to commercial creditors when assessed in a net present value sense. The Paris Club has long had a principle of so-called comparable treatment, but it has been imperfectly enforced. And I'm not aware of any sovereign debt restructuring that has been reversed as a result of a breach of comparable treatment. So the Paris Club's traditional comparable treatment principle may not be adequate, and they may wish to look for something more robust in the form of a most favored creditor undertaking.
Thank you. We have a number of follow-up questions also on value recovery instruments. One of them, can you explain more about VRIs? What modality exactly will they use? Sri Lankan remittances are expected to be much higher in the period ahead. Is there potential to link VRI payouts to remittances rather than things like oil or GDP? And with a value recovery instrument, isn't there a risk that some creditors get paid out much higher than others who have already settled on restructuring terms? And I think they're referring to domestic creditors here. And then maybe tenuously related here, do you see Sri Lanka considering debt for nature swap as part of the broader external debt restructuring discussions? Is this something that can potentially be put on the table as well?
The answer to the last part of that is yes, it certainly could. And I would expect there will be some discussion of that. A debt for nature component is popular at the moment with significant segments of the institutional investor population. They wish to burnish their so-called ESG credentials, and some link debt for nature, debt for sustainability feature is, in my view, likely to form part of the eventual debt restructuring package. The value recovery instrument, you could look for an element like remittances, like exports of the principal commodities, but I think that's probably going to be difficult. The more likely candidate here would be gross domestic product, and that is what has been used in recent debt restructurings for Greece, for Ukraine, and other countries. And what it will say is the projection for GDP in future years is this. If actual GDP exceeds that baseline by a significant extent, it's a pretty good proxy for saying that prosperity has returned, and that would trigger the payments under a value recovery instrument. Your point about the differential treatment is, I think, a good one. Value recovery instruments have not been used in bilateral debt restructurings, and one might see a situation in which the Paris Club or non-Paris Club bilaterals say, wait a minute, if commercial creditors are going to get a value recovery feature, so should we. And that could either take the form, in that context, it is much more likely to take the form of an automatic foreshortening of maturities or increasing in interest rates. You saw something like this in Zambia recently. But the other element of this that we have not confronted in the sovereign debt world in the past is domestic debt restructurings, which have not been a regular feature in sovereign debt workouts in the last 40 years, largely because domestic debt has not been a significant component of those debt stocks. But there is an argument to be made, wait a minute, if all creditors are to be treated equally, at least in a net present value sense, and some of them get value recovery features, why don't the others? So that is completely uncharted waters.
Thank you, Lee. I do see Khalid Salami, I see your hand up. I'm going to unmute you now and you can ask your question directly. Oh, never mind. The hand went down. Okay, I'll continue then. Number of fiscal related questions for you, Dr. Coomaraswamy. One of them is, you mentioned that the public should speak up if politicians deviate from the IMF program, but given the austerity that's been imposed on the public, people may push politicians to deviate from the agreed program. Could you please comment on that risk? And similarly, no one talks about cutting recurrent non-financial state expenditure drastically. Why is this? And is there scope to cut expenditures rather than focusing on the revenue side of the equation? You're on mute still.
Okay. In terms of the first one was the austerity and the impact it is having on people, and whether they are actually going to speak up in favor of sustaining the recovery program. I think, there are two ways of looking at this. One is that this is an austerity program. The other is that this is a recovery program. It's a question of what your perspective is. Now, having got to where we did get to, right? I mean, that's immutable, it can't be changed. That's where we were. So how do we get out of there? It is not possible to get out of there without a lot of pain. It's like if you have a patient who is very sick, and then the doctor said you either have to take very strong medication or have surgery or whatever it is, you can't then say, well, no, look, that's too much. I want something far less severe. You're not going to get better. That's the problem. Are we interested in recovering and having sustained growth in the future? Or do we want to become, say a country like Argentina, where you have, you're going from one restructuring to another, and a country with a lot of potential, not being able to break out of this low-level economy that they have had for now a number of years. So it's up to us. We want to muddle along with the situation becoming progressively worse, or do we have to get out of it? Or do we want to get out of it? And if we want to get out of it, sadly, we are going to have to go through some pain. That is inevitable. Now, the question is, there are ways and means of sharing the pain in such a way, sharing the burden in such a way that you protect those who need protection. And this is where I think that the whole social safety net is so important. And you have to give much, that's extremely high. And this is something people criticize the IMF for not being concerned about social issues. They have actually put a threshold for the minimum threshold for expenditure on the social safety net in Sri Lanka. So we need to make sure that we provide this safety net for the people and then go through the reform program. First, the stabilization. But now we have done much of the work on the stabilization already in terms of, there's some more to come, but quite a lot has already been done, right? In terms of taxes, in terms of interest rates, they're on their way down and on their way down sharply. The exchange rate is depreciated, and that has been built into the cost of living. That is true, but it is stabilizing, hopefully. So progress has been made, and we mustn't let go. If you look at our history, I mean, I've said this many times. I'm sure the Sri Lankans are now rolling their eyes because they've heard me say this so many times. From 1948, it's the government fiscal operations that has dragged us down. A toxic combination of populist politics and a entrenched entitlement culture among the people. They've fed off each other and were mutually reinforcing, and they've pulled us down. So we need to fix the fiscal. Once and for all, we need to fix the fiscal. If we can, that will give us a foundation from which we can build. And so that I guess, I have a big problem. I am not able to speak in Sinhala or Tamil. Frantz Fanon said the people who can't speak in their mother tongue are the wretched of the earth. So I fall into that category. But I think that the governor has been explaining things very well, and others who understand this situation need to keep explaining to the people that we need to stay the course. If we don't, things are going to be much worse. Okay, what was the second question? What was the second question, Patrick?
The second was on scope for cutting expenditure. Why is the program is concentrated on the revenue side?
Yeah, recurrent expenditure. The thing is, recurrent expenditure is very sticky. So we have one, public service salaries and pensions. Two, we have interest payments. And three, we have social welfare payments. Those are extremely difficult to cut. Over time, we need to shift people from an unproductive public sector into a more productive private sector. But for that, we need to create the conditions for private sector activity to get moving. As one sees greater buoyancy in the private sector, then you can start reducing the size of the public sector. Now, you could argue it's a chicken and egg question that you can't do one without, before you do the other. But I think that is the difficulty. These are very sticky expenditures. Interest is a kind of a sunk thing. You have to pay it out. and the salaries and pensions and social welfare. So it is difficult, but we are going to have to do that. You see, what invariably happens is when we get expenditure cuts, it falls on capital expenditure, and sometimes on a very important capital expenditure. So it's a tough thing. So we build up revenue and create more space, I think, for expenditure, and at the same time have a long-term view in terms of reducing the size of the public sector. I mean, there are the SOE losses they have addressed through the pricing changes that are taking place. And that has to be sustained. And in terms of the numbers of people over time through natural attrition and other ways, we need to reduce that as well. But as I said, you have to create the conditions for the economy to become more dynamic and to start absorbing labor in other parts of the economy, other than the public service.
Thank you. We do have quite a few questions, but we're coming up on the top of the hour, at which point we have a hard stop. So I'll try my best here to combine as many of these into one final push and then hand over for some closing remarks. So please pardon any run-on questions here, Lee and Indrajit. But we do have a few questions on collective action clauses. Do you see CAC indentures in Sri Lanka's international bonds as being helpful to the restructuring? How does exposure of commercial lenders tie in here? Similarly, what debt instruments would be best to hold in your view in terms of the indentures? I'm not sure if you can answer that, but and then some other questions that are kind of a bit more technical on the restructuring front. If Sri Lanka issues fresh external debt before the restructuring exercise is completed, will this debt be considered part of the funds that have to be restructured? There was a few to that effect. And then more generally, what's your best guess for the restructuring going through this year? What probability would you assign, and what are the risks to that view? And is there a risk of a future government putting the debt restructuring to a referendum and thereby making it null and void by way of infringing on their sovereignty? So that's a few different questions. Hopefully you can take those, Lee.
Yeah, Patrick, let me try to deal with those quickly. Will the collective action clauses in the underlying bonds be useful in this debt restructuring? Almost certainly, yes. The purpose of those clauses, of course, is to suppress holdout creditor behavior so that we don't return to a world in which 90% of the bondholders agree to a debt restructuring, but 10% of them choose to pursue a path to a preferential recovery. The awkwardness in Sri Lanka's debt stock is that we changed the nature of collective action clauses pretty considerably starting in 2015. So the old style collective action clauses operate within the four corners of each series of bonds. After 2015, we have moved to a so-called aggregated collective action clause, which looks to create a single voting class of holders of all bonds containing an aggregated clause. Sri Lanka bonds are a mix of those two things, and that will be an awkwardness, but the existence of the collective action clauses is undoubtedly going to be helpful. As for the new lending, the statement of policy in April 11 of last year that established the moratorium on payments tried to be very explicit in saying that any new lending or any disbursements under existing facilities that occurred after April 11 would not be picked up in the debt restructuring. That's a pretty common feature for both commercial and bilateral debt restructurings. You don't wish to discourage anyone from lending into the crisis situation. The prospects for the debt restructuring this year, could it be completed? Yes, it could. Will it? I'm not so certain. It gets, as I say, bogged down in these inter-creditor group rivalries and concerns. And the question will be whether the Paris Club is prepared to move ahead without commitments from China and India as to their policy. And then, of course, whether the bondholders are prepared to do so. So the sand in the gears in 2023 in sovereign debt restructurings really is resulting from these inter-creditor group rivalries. There's certainly no technical reason why it needs to get bogged down. It is simply, I think, a question of whether the creditor groups are going to be prepared to move forward. And to go back to the theme we touched on earlier, some form of most favored creditor undertaking might lubricate that process.
Thank you. And then the final set here, we have a couple on the domestic debt restructuring. One of them, is there a possibility of a second DDO in the event that the first one is insufficient? And if so, would you assign a higher probability that financial sector holders that have been excluded this time around are looped into the process? On the other side of the coin, rumors are rife in the domestic equity markets that local banks might get paid out better than international creditors through special agreements in rupee terms. Do international creditors have any recourse to complain if that happens? And then the last set, and this is for either of you, is divestment of SOEs part of the agreed restructuring program? If it's part of the IMF program and not the restructuring agreement, is there a risk that the government deviates from this strategy? And can you comment a bit about the case brought against Sri Lankan Airlines debt? Why can't that be treated like the ISBs?
To whom are those addressed, Patrick?
I think those can go to either of you. I think the first set probably for you, Lee, and the second set maybe for you, Indrajit.
Okay.
Indrajit, do you wish to go first?
No, please go ahead.
Patrick, repeat them in order, just very quickly.
Sure. The first is on risk of a second domestic debt operation if the first proves insufficient, and the second, is there a risk that local bondholders are treated better than international creditors, and that this causes a dispute in the future?
Yeah, is there a risk? There's always a risk. The government has exempted the local commercial banks. Domestic debt restructurings are difficult because while you're trying to extract debt relief, you're trying to extract debt relief from investors in the country. And if you do it too aggressively, you wind up destabilizing your own domestic markets and have to recapitalize the institutions from whom you have obtained that debt relief. Greece had to set aside 10 billion euros to recapitalize the effect of its debt restructuring on its domestic institutions. So the government in this case has taken the view that the commercial banks have already made a very significant contribution. Is it possible that over time, in rupee terms, they wind up getting a better deal? That is possible. I don't think that would be something that the external bondholders are going to be particularly concerned about. They look principally to how the foreign exchange reserves of the country are being distributed among claimants to the foreign exchange reserves. So I wouldn't expect that would trouble them overly.
Great, thank you, Lee. And then Indrajit, the last ones were on SOE privatization plans and on the Sri Lankan Airlines debt in particular.
Okay, on the divestment plans, it is part of the structural benchmarks of the program. And as I said, 7 entities have been identified, and there has been a high-level committee that has been appointed to implement those divestitures. And to the best of my knowledge, they are working pretty assiduously to move things forward. It has not gone as quickly as would have been desirable, but it is moving forward. And the last I heard was that they are hopeful that by the second quarter of next year, somewhere before the middle of next year, they will get most of the transactions done. So it's now a question of kind of working through them. And they want to do it as transparently as possible. And so it's taking time. But yeah, it will be done. The Sri Lankan Airlines, this is a little bit above my pay grade. I'm not very familiar with it. But my understanding is that Sri Lankan Airlines is incorporated as a company. So while it is a public sector institution, it's not on the government balance sheet, if you see what I mean. So that is why its debt is of a different category than the debt of, say, some of the other entities where the debt was on the government balance sheet eventually. I hope I'm right in saying that, but I think that's the difference between Sri Lankan Airlines and the other entities which are not incorporated as companies, which are incorporated under the Corporations Act.
Great. I think we'll leave it at that. We've come to the top of the hour. I know there's still a lot of questions left, so apologies to those whose questions I was unable to get to. But thank you to Lee and Indrajit for graciously answering so many questions. I'll hand over to Vajirapani to take us through some closing remarks. Thanks, everyone.
Right, thank you, Patrick. So that concludes the Q&A session. So before we wrap up, I would like to know your final remarks, particularly what's your key message to the Sri Lankan public and policymakers? Over to you, Dr. Coomaraswamy and Professor Buchheit.
Well, I think the message, I think just 2-3 lessons maybe one should draw from our experience. One is do not delay in going to the IMF once things start going wrong. I think we knew by the second quarter of 2020, when we applied for IMF support under the Rapid Finance Initiative, which was used to support countries during the pandemic. 94 countries were supported out of the RFI, and we were not given any money, though we applied for it. As I said, people should ask questions. Now, that's the time when we should have started asking questions as to why are we not getting this money? It's $800 million we were entitled to. 94 countries got it. We didn't get it. That is simply because by that time, the IMF had determined that our debt was not sustainable. So we knew then. And our reserves at that time, please correct me if I'm wrong, but was something like about $3 billion USD. So if we kind of didn't delude ourselves and really faced up to the crisis that was before us and moved to have a fund program and restructure our debt at that point, it would have been a far less painful, far less onerous adjustment that would have been required. So one thing is, don't delay. The second thing is, once a crisis hits, these crises disproportionately affect the poor and vulnerable. So when you are constructing a recovery program, a stabilization and recovery program, the first thing you need to do is to look at your social safety net and to see how it can be strengthened to protect those who are going to be most affected and those who have the least resilience in the face of a crisis. We are doing it now, but in my view, that should be the first thing, up front in the program. That should be done. And, the multilaterals are giving us money to finance these things. So we can raise money for these things. So that's the second message. And the third thing is, we have never been able to do both stabilization and structural adjustment. We need to have the bandwidth to do both. We've had some success with stabilization in the past, but as I said, the political calendar usually undermine progress. But on the structural reforms, we have been very weak. So we need this time to be fully focused on it and do both. And somehow manage to manage both. Thank you.
Professor Buchheit, any final remarks from you also?
Yes, well, let me emphasize the first point that Dr. Coomaraswamy made. The Sri Lankan authorities at the beginning of last year made the mistake of deciding that they would continue an attempt at normal debt service long past the point that it was clear, I think, to any sober observer that was no longer going to be possible. This is not a sin of Sri Lankan authorities only. Frankly, that is the norm. If you look at countries facing severe debt difficulties, they often, I almost want to say invariably, delay too long in attempting to take remedial action. Somehow, when intense debt distress appears on the horizon, government authorities develop a profound belief in the efficacy of prayer. And it results, as Dr. Coomaraswamy says, inevitably in much more severe debt workouts than would otherwise be required. Looking forward, there are two things that I would say to the authorities. The first is, do not let it get bogged down. There will be an infinite number of reasons, political and financial, why other actors in this drama do not wish to see a prompt and orderly debt restructuring in any country. And they will try to slow it down. Look at Zambia. Zambia is going on its third year after announcing the need for a debt restructuring. The price that is paid for that delay tends to be the citizens of the debtor country. So my advice would be buffalo ahead and overcome those obstacles or circumvent them. Do not let it become bogged down. Final comment, because I believe very strongly in this, in the world in which we live, the government has committed to the principle of comparable treatment of creditor groups. There's always an exception for that for domestic creditors for the reason I mentioned, that you cannot visit the same terms on them without destabilizing the domestic financial system. But in terms of external creditors, the principle of comparable treatment, I think, is the only safe haven on which the government can stand in order to move this process forward. I'll stop there.
Okay. Thank you very much, both of you. So, ladies and gentlemen, with that, we are going to conclude today's event. And we are incredibly thankful to our very eminent panel, Dr. Coomaraswamy and Professor Lee Buchheit, for taking time out of their busy schedules and joining us today. And thank you so much, Patrick, Vindhya, for moderating the session. And lastly, thank you very much, audience, for being a part of today's event. You may now disconnect the call. Thank you.